So what are YCG's thoughts on the AI trade?
It reminds us a lot of these big breakthrough innovations that result in these massive sort of capital-intensive technology booms of the late 90s, early 2000s, and it reminds us of kind of the railroad boom of the 1850s where, yes, demand is very strong, but everyone is putting all of this capital into it and it's very unclear what the returns are going to be on that capital investment. And in fact, what you've seen in the past is that a lot of times the demand may not be quite as fast and happen quite as soon as people think. And then on the supply side, a lot of times what happens is that there are innovations that cause there to be less supply of goods and infrastructure to service those demand needs than anticipated. And so what that means is, supply greater than expectations, demand a little bit less than expectations. That means that a lot of times profits and prices will, very much disappoint relative to expectations. We do own some of the big technology companies that are exposed, and that are viewed as AI winners, but we don't own them in as concentrated a way as the index because we think it's not diversified. The index is not diversified enough across different themes. And so I would say if the AI boom continues unabated, that we should do fine because we do have exposure. And if the AI boom turns into a bust, then I think we'll also do fine over time.
I think you've seen that this year. Frankly, in April, it proved important not to be overly exposed to kind of one investment theme.
You think about DeepSeek came out of nowhere. Nobody had even heard of them or anything at all. And prior to that time, people are saying, well, this is how much power is going to be needed. We're going to need multiple skyscrapers. And then all of a sudden DeepSeek comes along and says, well, actually we can provide similar quality output with fewer powerful chips that require far less energy. Does it reduce costs in the whole industry? Or do you end up just using more of this cheaper version to get even better? And it reminds me of when we did fireworks shows and we got a license, we could get fireworks at like 70% off at a wholesale price off the retail stand price. And we looked around at each other like, should we just go for the same fireworks show we've always been doing with the same budgeted money? Or should we throw in a lot more and make a much bigger show? And the argument there is that maybe the demand of the chips will remain the same because they'll just get more of them now. But I think the point is, again, these things are pretty difficult to predict. They tend to be, as Elliott was saying, the demand probably is being overestimated or overestimated in its time frame, and that the supply can come on quickly, and it can really make it difficult to assess what will the returns on the innovation be. But what is certain is this is transformative, and it's going to make a big difference in productivity over time and be something that will be a blessing for all of us. It's usually the consumers that end up benefiting the most.
I think one thing's for sure is that we're still in the early innings of the whole AI build out. And I know we've talked about in-house here that the real winner of AI may not even be publicly traded right now. And I think for us, from a comfort level, we'd much rather have exposure to AI through these large global technology businesses like Amazon, Apple, Microsoft, and play the AI trade through them because they have massive balance sheets. They have other very, very profitable businesses, and they can acquire these smaller AI businesses if it's additive to kind of their suite of services that they provide.